So, you own stocks, but are they really working for you? Or are they just sitting there? Today, we're going to dig into a strategy called the covered call. It's often talked about as a way to earn some extra income, but really, it's a fascinating story about a fundamental trade-off. Let's break it down.
I mean, think about it like this. What if you could make your stocks pay you rent? That's really the big promise of a covered call, getting paid for owning shares you were probably going to hold on to anyway. It sounds amazing, right? But how on earth does that even work?
All right, let's look at the promise of the covered call. We're going to see who's involved, what's actually being traded, and what makes this idea so compelling to so many investors.
So first things first, who is a covered call writer? Well, to put it simply, it's just an investor who owns at least 100 shares of a stock and decides to sell a contract against those shares. The key word here, and you got to remember this, is covered. You're covered because you already own the stock. That one little detail makes this strategy worlds apart from other, much riskier options trades.
Okay, so you're selling a contract, but what is this thing you're selling? To really get your head around the covered call, we need to look at the anatomy of the trade itself. At the very heart of this strategy is something called a call option. Now, if you buy a call option, you're buying the right, but not the obligation, to buy a stock at a price you both agree on, called the strike price. And you can do that anytime before a set expiration date. But here's the twist. In our strategy, we're not the buyer.
Now, we are the option writer. We're the seller. And this is the part that changes everything. We're the ones selling that right to somebody else. And in exchange for getting paid, we take on an obligation. If the person who bought our option decides to use their right to buy, we are obligated, we have to, sell them our stock at that price we agreed on.
So why would you ever take on that kind of obligation? Well, it comes down to one simple, beautiful word: the premium. This is the cash that the option buyer pays you right up front. And it's yours to keep, period, no matter what happens next. And for a lot of investors, this is the entire game, generating that steady, consistent income.
But you know, there's no such thing as a free lunch in investing. That premium doesn't just appear out of thin air. It comes with a very specific set of trade-offs. This is that two-sided coin we talked about, a constant balancing act between an immediate reward and a potential risk.
The reward side, it's crystal clear. The second you sell that call option, you get the premium. That cash hits your account and it's yours. It's instant income from an asset you already own. But where does that value actually come from? Well, a huge part of an option's premium is something called time value. Think of an option like a melting ice cube. Time is its enemy. Every day that passes, its time value decays a little bit, and that decay gets faster and faster as you get closer to the expiration date. So for investors who are focused on income, selling these shorter-term options is a direct way to cash in on that rapid decay.
And now, let's flip the coin over. In exchange for that juicy premium, you accept two very specific risks. First, you're agreeing to put a ceiling on your potential profit. And second, you are not getting rid of the risk that your stock could tank. This quote from the source material just says it all, doesn't it? If your stock suddenly soars, it just goes to the moon, you don't get to enjoy that massive run-up. Nope, you've already agreed to sell at that lower strike price. That's the deal. You've essentially traded that unlimited upside potential for a fixed, guaranteed payment today. And this right here highlights the other equally important risk. Selling that call option is not a parachute. It doesn't protect you if the stock price falls off a cliff. You still own the shares, so if they drop, you feel that pain, cushioned only by the tiny premium you collected. So think about it. Your upside is capped, but your downside remains pretty much wide open. So, you've sold the call, you've collected the cash, you've accepted the trade-offs. Now what? Well, it all comes down to the moment of truth. Where is the stock price when that contract expires? And really, there are only two paths this whole thing can take. At the end of the day, it's all about where the stock price lands compared to the strike price you picked. If the stock is below the strike when the option expires, congrats, the option expires worthless. You keep your shares and you keep 100% of the premium. This is what you want if your goal is to hold the stock and just keep collecting that rent. But if the stock is above the strike price, the buyer is going to exercise their right. You get assigned, which is just a fancy way of saying you are forced to sell your 100 shares at that strike price. You still keep the premium, of course, but you have to say goodbye to your stock. All right, let's pull all these threads together. The covered call strategy, when you boil it all down, is a very clear and defined bargain. It's a deal you're making, a conscious decision to trade one thing for another. Here's the bargain in its simplest form. 1. You get paid a guaranteed but limited amount of money right now. 2. In exchange, you give up all the unknown, potentially unlimited profit if the stock goes way up. And 3. You keep all the downside risk if the stock goes down. That's the deal, every single time.
And that brings us right to the final, critical question that you, as a potential covered call writer, absolutely have to ask yourself. Is that immediate, guaranteed income really worth the risk of missing out on a massive rally in your stock? The answer? Well, it's different for everyone. It depends entirely on your goals, what you think the market will do, and your personal tolerance for regret. There's no single right answer, only a trade-off that you have to be comfortable making.